Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 29th, 2025. How you doing? I hope you're doing well. Boy, what a week we had in the markets, huh? Especially the last Wednesday, Thursday, Friday. Wow, big sell-off. We had that rally, pretty much gave it all back, but it's an interesting week. Um, and so I hope you're staying safe out there, and I hope that you have a plan for your trades so that you don't just have to be reliant upon your emotions and your psychic abilities, right? Because if we all knew where the market was going, we'd all make a lot of money. But me personally, I don't have that skill. So what I have to do is I have to follow what my trade plan is. So I hope you have a trade plan, and I hope you are following, because in the long run, that's the way that you're going to be a long-term profitable trader, is actually having a process and actually following that process. Not every week's going to be a green week. Not every month is going to be a green month. That's what people don't understand. You're not going to make money every single day. But there are certain times of the year where you will make the majority. But the key is always that your risk to reward is a good risk to reward with an asymmetrical risk. Or in other words, when you lose small. When you're right, you can have a big win. That's really what it comes down to. So, thanks for coming. I hope you're going to learn something today. The format today, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the setups were, what the confluences were, how I'm going to position size correctly, how I'm going to place my emergency stop, how I'm going to place my end-of-day stop, how I'm going to take partial profits if the trade starts going my way, how I'm going to get into trailing stop mode and what that means, and then ultimately how am I going to exit the trade if we get to significant overhead resistance levels, and then start looking for another one. So we'll talk about when I entered the trade, why I entered the trade, and how I am going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and follow it, and that all comes down to trader psychology. So I always like to teach it. It's helpful for me, and I hope it's going to be helpful for you. After that, I have gone down through my master watch list. I went through that last night. I do it every Friday night. And I look for potential trades in the coming week. Now, these markets that I'm looking at and have highlighted, the price is not where it needs to be, but if it does get there, then because I'm going to show you, what the confluences are, what the major support levels are, and then if the price action is correct based upon those levels, I will consider using or getting into the trade. One of the major advantages you have as a small retail trader is the ability to just wait for the price of that market to come exactly where you want. And normally where you want is support, confluences, and a good risk to reward ratio. So I'm going to share with you what I'm looking for potentially next week on the daily, and also what I am potentially looking for on the weekly. So I hope this is going to be helpful for you. If it is, I really would appreciate it if you could hit the thumbs up button. It really helps the channel. Or if you could subscribe to the channel, that would be even better. But it really does help out the channel and lets YouTube know that there's some valuable content here. So with that, let's run the U.S. legal disclaimer, get that out of the way, and then we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get started. let's go through the current open trades that I have at the moment. So on this is Apple, and obviously I'm going to explain why I took the trade. I'm going to be a little more detailed on this chart, and then on the other trades and positions that I have, I won't be as detailed. So if you're like, wow, he's really getting into a lot of detail on this particular chart, don't worry, it's just the first one. Okay, so I did get long Apple back here on the 14th of March. Why? Well, there was a confluence here. You can see this green box here. This is called an order block. And an order block, I really love order blocks. They're really a good place to take a look for a place for a bounce. If I go all the way back to the lowest bar close before we make a market change structure to the upside, I highlight that area and then I draw it out into the future. If we get back to that area, it doesn't have to bounce there. And this week, some of the order blocks were lost, but it is a really good area where it tends to bounce more than it doesn't. So number one, I have this order block that the prices come back down to. Secondly, I also have the 300-day moving average. Now, the previous day or the day before I took the trade, it closed under the 300. The next day, it closed over the 300. This is a legitimate entry signal by itself, but in addition to the close under the 300-day moving average and close over the 300-day moving average, it also rejected the bullish order block. And in addition to that, we also went under 30 RSI the previous day, and then on the day that I took the trade, it closed over the 30 RSI. So that is a high quality entry. Rejection of the 300-day moving average, rejection of the 30 RSI, and a rejection of the bullish order block. Now, if I could take this trade every single day, I certainly would, and I'm certain in the long run that I would make a lot of money if I could have this good of a setup every day. Unfortunately, we don't have them, so we do what we can do. But this is a really good setup, and so I took it here at 213.50 on the 14th. Based upon what I just said, the rejection of the bullish order block, the under over 300-day moving average, and the under 30 over 30. So now, as soon as I buy this, the first thing I need to decide is how many shares am I going to buy? And in my opinion, this is one of the most important things about trading: is how many shares you buy or short or whatever. That's position size, right? So I'm going to show you how I manage or how I decide how many shares I'm going to buy, what my position size is. It's a simple formula, but it takes so many things into account. And the first thing I take a look at is how much do I have in my trading account? Well, let's just say I have $50,000. It works if it's 50,000, 100,000, 200,000, a million, 275,000. It's very simple. I just take 1% of my total trading capital at the time. Let's just say it's 100,000. 1% of that is $1,000. Or if I have $50,000, 1% of that is 500. So let's use the 50,000, 500. I take the 500. On the day that I'm entering the trade, I look to see what the average true range is of 2. So the 2 ATR, it's 1266. This is 2 times the average true range. So it's 1266. I take that $500. I divide it by 1266. And this tells me to buy 39.49 shares. So I can round that down to 39, or I can round it up to 40. Technically, this is 39.49, so let's just round this to 39 shares. So this is how many shares I'm going to buy. And you may have heard me talk about you need to position size based upon volatility. Well, the 2 average true range does that for you already. So when volatility is higher, we're going to buy fewer shares. When volatility is lower, I'm going to buy more shares. The problem is volatility can double and triple, and people are still using their same, I always buy 300 shares. Well, that's great, but if volatility is increased 3 times, it's like you've bought 900 shares, right? So if you use this formula, this will always keep you on the straight and narrow of exactly how many shares you should buy because it factors in volatility. So $50,000 trading account, 1% 500, 500 divided by the value of the 2 ATR tells me to buy 39 shares. Okay, so now I know how many shares to buy. I have my signals, as I just mentioned, entered at 213.50. I buy my 39 shares here, 213.50. The first thing I do now is the value of the 2 ATR that I just used, 1266. I take my entry price minus 1266, and that is my emergency stop. So if I buy here at 213.50 and it goes down $12.66, how much have I lost? I've lost exactly $500, right? I've lost exactly 1% of my trading account. And if it gets there, I just sell. I've lost 1%. That's how it goes. But the good news is that only happens about 5% of the time. The other 95% of the time, if you have a loss, it's going to be based upon your end of day stop. So I always have two stops. I have an emergency stop and I have an end of day stop. And that end of day stop almost always is going to be much, much closer to your entry price, giving you a good risk to reward ratio. Okay, so but the emergency stop is 2 ATRs below my entry price. My end of bar stop, depending on the strategy that you use, but this is a combination of many, but ultimately I took the trade on a deep dip buy with a close under the 300-day moving average, a close over the 300-day moving average. So now my end of day stop going forward on this trade, at least at this level, unless we were to get higher, is a close below the 300-day moving average. So if the next day it just simply had closed below the 300-day moving average, I would be out, but I'd be out for a much smaller loss than if I'd hit my emergency stop. So you know exactly what your worst case scenario is. You don't know what your end of day stop is, but almost always your end of day stop is going to be a much smaller loss than your emergency stop, which is 1%. But like I said, that only happens about 5% of the time. So have the entry, I position size, I know where my emergency stop is, I know where my end of day stop is. Now the next thing I do is I take my entry price and then I look for the value of the 1.5 ATR. Right now it's $9.50. So whatever the value is on the day that you enter that, you take your entry price and add the 1.5 ATR to it. So this is, if we get to this level, if you get to your 1.5 ATR, now you are in trailing stop mode. And so that means in the future, if you have a close below previous bar's low, I would be exiting half. And I'll show you on the trades that I have open why that was such a good idea this particular week when we go through the other trades. But the thinking is once you get 1.5 ATRs above your entry, you don't want to give it all back. And so going into trailing stop mode does that for you. So, all right. And you can see here's the 1.5 ATR, and you can see we did reach it. So now everything I've talked about so far, the position sizing, the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive maneuvers, okay? In other words, if the price does something I don't want it to do, I take action. These are all defensive moves, but I like to play offense in my trading as well. And I do that by taking partial profits of the existing position size that I have at the time if the market moves up a certain amount. And I'm going to show you exactly how I do this. So profit targets, and I change them each day. And what do I do? So we closed Friday 217.90, right? So I take 217.90. I add the value of the 0.45 ATR on that particular day, and that will show me how many shares, that will show me the profit targets for the coming day for my partial 0.45 profit targets. So anyway, this will explain it. So this is for Monday. Right now we're at 217.90. So I take 217.90 I add the value of the 0.45 right now, which is 285. My first profit target for Monday only, is 220.75. So 220.75. That is my first profit target for Monday, 220.75. Now I'm going to place a second profit target. I take my first profit target, 220.75. I add the value of the 0.45 to it again, plus 2.85. My second profit target for Monday is 223.60. That's my second profit target, 223.60, and I do it one more time. I take my second profit target, 223.60, again, add the value of the 0.45. So my third profit target for Monday only, 226.45. So now I have 226.45. So now I have 3 profit targets for the coming day. So the question is, how much do I sell at those particular levels? I sell 10% of however many shares I go into the day with. So if I went into the day with 100 shares, I would place a limit order in the system to sell 10 shares at 220.75. I put another 10 shares at 223.60 and another 10 shares at 226.45. And if I hit one profit target, okay, I've taken off 90 shares. So now I have 90 shares going into the next day. And going into the next day, set my profit target. Now I have 3 profit targets for 9 shares, right? Because 10% of 90 is 9 shares. And if you have a down day, you're not going to hit any profit targets. But I really like to take partial profits. I think it's helpful in many ways. One, it reduces your position size, helps you follow your process better. 2, you have locked in potential gains that the market cannot take them away from you. And if you do have a big move down, but you've had a week or 2 weeks of taking profits, it mitigates your loss to the downside if you do have a week like we had last week. Okay, so that's pretty much it. Let's kind of do a quick review of this trade and kind of put it all together. Okay, so I entered on the 14th of March at 213.50. Why? Okay, multiple signals. 1, we rejected the top of the bullish order block. 2, we had a deep dip buy signal of a close under and then over the 300-day moving average. We had another deep dip buy signal where we closed under 30 RSI, closed over 30 RSI. So I position size as I showed you. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. I placed my 1.5 ATR trailing stop level 1.5 ATRs above my entry. And now I know what to do regardless of what this trade does, right? I have no control over this trade, but I know exactly what to do regardless of what happens in the future. And that's key. You need a plan to do that. And if you don't have a plan to do that covers all areas of your trade, you need to get one. I'd be happy to help you. I teach one-on-one courses. I've taught them for years. I teach a 15-hour course where I teach you the rules of all of my trading approaches. Like I've taught people from absolute beginners all the way up to the hedge fund level. So, if I can help you with that and you would like to study with me and have me teach you one-on-one, it'd be great to have you as a student. My email is in the link of the description of this YouTube. Just reach out to me. We can start the process. But whether you learn it from me or whether you learn it from someone else, you've got to get to the point where you're in a trade, you know exactly what to do regardless of what happens. Okay, so we take the trade. We place 1.5 ATRs above. We'll just kind of go through it here day by day. Next day, yeah, it went up a little bit, but not enough for a profit target, but it didn't close below the 300, so I'm still in the trade. The next day, it still closes above the 300-day moving average. I'm still in the trade. The next day, it goes up. I hit a profit target. Great. Next day, it was down a little bit. Next day, we opened lower. but closed higher, right? I always make my trading decisions based upon the closing price. So it did open below the 300, but it ended up closing higher. So I'm still in the trade, also hit a profit target. Next day gaps up a little bit. I can't remember if I hit a profit target there. Then the next day goes up, hits a profit target, also gets to trailing stop mode. So now I'm in trailing stop mode, which means if I have a close below a previous bar's low, I will get out of half of the position. Okay, so we get to trailing stop level, next day's down, next day's up, hit another profit target, and then boom, look what happened on Friday. Did we close below a previous bar's low after reaching trailing stop level? Yes, we did. What's my rule? I get out of half of the remaining shares that I have. So currently, I'm up 2.01% on the remaining shares. But look, if Apple continues to come down, look at some of the profit targets that I took up here. Took profit targets here, took profit targets here, took profit targets here. Not the whole position, but maybe one, or I think one day there was 2 profit targets, the other ones were just 1. But still, I took off profit targets at a higher level than it is now. And now I've completely reduced my position size to half. So anyway, up 2.01% on this particular trade. What's my stop going forward Monday if it closes below the 300? Well, got to get out of the trade. If it moves up, hits profit targets, great. If it moves up higher and gets to the 65 RSI level, then another rule comes into place. If it gets up into the 70 RSI level, another rule comes into place. So I have rules for no matter what happens, and it's a nice freeing kind of way to trade rule-based. And in my 30 years of experience of trading, the people that make the money have a rule-based approach. So Apple, deep dip buy, up, sold half with a 2.01% profit. All right, let's go to AMD. All right, AMD, this was another combination of 2 different trading approaches that I used. You see the green box, so that's a bullish order block. And then it's also it's a bullish order block in conjunction with a deep dip buy. So I did enter AMD here at $100.50. Why? 1, we're in the bullish order block. 2, deep dip buy. The previous day we closed under the 30 RSI. On the day that I took the trade, we closed over the 30 RSI. And we also rejected this long-term channel here as well. So that's the reason I entered the trade, $100.50. I position size, like I explained to you before. I placed my emergency stop 2 ATRs below. My end of bar stop is if we have a close below the 30 RSI, because essentially that was my entry trigger. Close under 30, close over 30. Therefore, in the future, if it closes back under 30, I'm out of the trade. And so entered here $100.50. I placed my 1.5 ATR trailing stop level above. Soon as I bought it, it started to go down, 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 down. I stayed in the trade. Why? Because it never closed under the 30 RSI. And then we started to move up. We went up, I hit some profit targets, then I moved down, up, hit some profit targets. Nice big up day, hit more profit targets, and also got to trailing stop level. So now in the future, if I have a close below previous bar's low, I'm going to get out of half. Boom, another big day up, took more profit targets, couple sideways motion, huge move up, took more profit targets, and then I got out of half of the, I got out of all the, I got out of half the position here. Why? Because we had our first close below a previous bar's low. Obviously here on the 26th, we closed below this previous low after reaching trailing stop level. So I took off half of the remaining shares that I had for a gain of 8.8%. Pretty good. And now the last couple days we have come down, and we have come down, obviously no profit targets, but was I glad that I sold half up here? Extremely glad that I sold half up here. Was I glad that I took partial profits here and here and here? 100%, right? So now, listen, on this particular entry, because it really started off with an under 30 over 30, I have a rule. If I buy something based upon an under 30 over 30 and it moves up to my trailing stop level, and then if it comes back to my entry point, then I just get out of that remaining shares at a break even. So again, if I have an under 30 over 30 that gets me into the trade, not a moving average, but just an under 30 over 30, and I ever get to trailing stop level, then if it comes back to my entry point, I am out at that level for break even. So Monday, if this comes down, touches my entry position, I will be out of the trade. Did I break even on the trade? Absolutely not, because I took partial profits, and then my trailing stop mode got me out of half the position way up here. So it's a good week to demonstrate to you why these trailing stop modes and taking partial profits for me work so well. So I got out of half the position for a gain of 8.8%. The remaining shares that I have at the moment, when you take out the trailing stop that I got out of half and all the partial ATR profits that I took during the day, up 2.77%. So that's AMD. All right, let's go to DIA. DIA, another combination of an order block and a deep dip buy. The deep dip buy happened here on 3/13. I got in the trade at 408.90. For one, we're in the bullish order block. For two, we rejected, this is called an intraday rejection of the 300-day moving average. This is a deep dip buy strategy. I got in at 408.90, placed my emergency stop 2 ATRs below. My end of bar stop is just simply a close below the 300-day moving average. I mean, it closed like 3 or 4 cents above it. So simply, if the next day had closed below, I'm simply out of the trade for a very small loss. So I place my 1.5 ATR trailing stop level above. Next day, moves up, hit profit target. Next day, moves up, hits profit target. Now I'm also in trailing stop mode, which means if I have a close below previous bar's low, I'm out of half. We move up, hit a profit target here. This day opened below the previous bar's low, but closed above. That kept me in the trade. No profit targets, but it kept me in the trade. Next day, up nicely, took more profit targets. Then we had this sideways motion, and then here on the 26th, we closed below the previous bar's low after reaching trailing stop level. What did I do? I took off half of all the remaining shares that I had left for a gain of 3.64%. And then Thursday and Friday, down big. Am I glad that I took off half up here with the trailing stop rule? Yeah, you bet I am. So I took half off for a gain of 3.64%, and the remaining shares that I have up 1.61%. Now look, here's the 300-day moving average down below, the orange line. If Monday we close below this, what do I have to do? I have to get out, right? Because that's my stop. So, I'll place my profit targets for Monday, the partial 0.45s, 3 of them. And if we move up on Monday, great, hit some of those. If we move down and it closes below the 300, simply out of the trade. So locked in half for a gain of 3.64%, and then the remaining shares that I have from this deep dip buy and order block combination trade up 1.61%. Okay, let's go to Google. Again, another example of why taking partial profits, why having trailing stop mode in these rules are so important. I got long Google on the 18th of March at 160.50, was inside of the green order block, also was a deep dip buy where it went under the 30 RSI during the day and then closed back above. That got me in the trade. I position sized correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is a close under the 30 RSI. Placed my 1.5 ATR above. And then next day we took off, hit a profit target, a couple days sideways, no profit target. And then here, nice move up, hit a profit target next day. And by the way, also on this day, got into trailing stop mode. Next day, up again, another profit target. But then here on the 26th, we have our first close below a previous bar's low. What do? I take off half of the remaining shares, and so I took off half of the remaining shares for a gain of 2.75%. And do you remember I just mentioned to you, if I take a trade with an under 30, over 30, and it reaches my trailing stop level, then in the future, if it ever comes back to my entry point, I get out of the remaining shares because it's break even. Look where it opened on Friday. It opened exactly at my entry point. So I got out of the shares, right? So now I'm out of the position. Why again? Because if I take an under 30, over 30, and I get to trailing stop level, then if it ever comes back to my entry, I don't want to get that nice gain up. And luckily, I got out right there about my entry price, and then it just collapsed during the day. So locked in half for 2.75%, and the remaining shares on this trade break even. But again, taking the partial profits, these were all at profitable levels. So all in all, nice profitable trade. Had you traded this with only an under 30, over 30, without the partial profits, without the trailing stop mode, you would have a big loss. But in this case, because of these rules, still a profitable trade. Amazon. All right. I took Amazon all the way back here on the daily charts on the 10th of March when it bounced at the 300-day moving average and also rejected the high of the order block. I entered at 194.60 position size, placed my emergency stop 2 ATRs below. My end of day stop going forward is a close below the 300-day moving average. I placed my 1.5 ATR trailing stop level above, and then of course I have my daily partial profits. Next day moved up, hit a couple profit targets. Next day nothing. Then we went down, sideways. Here on the 18th, I stayed in the trade because during the day it was under the 300, right? Remember, if it would have closed under the 300, I would have exited the trade. However, it managed to close back above the 300 by the end of the day, so I stayed in the trade. Next day up, profit target. Next day open down, but up, profit target. Next day up a little. I don't think I had a profit target on that day. Then we had a big move up where I took multiple profit targets. Next day, another big day up where I hit multiple profit targets. And then I also got into trailing stop mode, which means if I have a close below previous bar's low, I'm going to get out of half the remaining shares. And I did that for a gain of 3.19%. Thankfully, because again, on Thursday, it was basically unchanged. And then Friday, everything just went crashing down to the ground. Now, am I still in the trade? I am still in the trade because why? Because it closed above the 300-day moving average. Had this closed below this 300 on Friday, I would have been out of the trade. But it held my level, so I'm in. So the remaining shares that I have on this trade are now down 1%, but again, you can see why the trailing stop level rule is so important, because I locked in half at 3.19 and obviously took these profit targets on the way up. So you see why it's important to sell into strength? Really, it is, in my opinion. So the remaining shares I have down 1% on this particular trade. Okay, let's go to Caterpillar. Okay, Caterpillar, on the 4th of March, we rejected the bottom of the order block. That's what got me into the trade. I got long at 327.60. Placed my trailing stop level 1.5 ATRs above. Of course, I have my 2 ATR emergency stop below. Next day took right off for me, hit a profit target. Next day up a little, not enough for a profit target, but got into trailing stop mode. Next day up biggies. took multiple profit targets off. Next day down, next day, first close below previous bar's low after reaching trailing stop level. I got out of half of the shares for a gain of 3.81%. And then we just chopped around for a long time. Down, up, profit target, down, 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 up, profit target, no profit target here. And the last 3 days, just straight down. So my stop on this particular trade is just a close below the order block at 325.60. We're at 329.69. So the remaining shares here up, but not much, but still holding my end of day stop, which is closed below the order block at 325.60, but the remaining shares up 0.9%. Alibaba. Okay, this is a completely different trading approach that I use and I teach. This is called an abandoned baby. And you've heard me talk about these before. An abandoned baby is when you have a gap up followed immediately by a gap down, leaving that bar kind of hanging in space, kind of abandoned. That's why they call it abandoned baby. They work to the bullish side, they work to the bearish side, but this is a bullish one, a bearish one, because we gapped up. For whatever reason, the news was good, people were excited, followed by an immediate gap down. So when you have these drastic changes in sentiment, really bullish, really bearish, when I see this in my experience, about 70% of the time, you're going to look back into the future, or yeah, you're going to look into the future, I should say, and you're going to see this slower. Conversely, if you gap down, followed by an immediate gap up, more times than not, when you look into the future, it's going to be higher. So when this abandoned baby took place, I didn't short it when it happened, because usually what I see is a gap up, gap down, followed by a little bit more a move up to the bottom of the abandoned baby, and that's what got me short this position, because the abandoned baby formed, but then we had a couple day rally, and you see how on the day that I took the trade, it rejected the bottom of the baby. That was my signal. So I got short at 139.20. Now with this particular approach, this one's very simple. I don't take profit targets, anything like that. It's very simple. I'm short here at 139.20. I place my 2 ATR emergency stop above if I'm wrong, and I place a 4 ATR profit target to the downside if I'm right. So if I'm right, I will make twice as much as if I'm wrong. If I'm wrong, I'm losing 2 ATRs or 1% of my account. If I'm right, I'm making 4 ATRs or 2% of my account. And that's just proper risk to reward. You always want to be able to make more than what you are risking. It's called asymmetrical risk. So this one, I just set it and forget it, right? So we had the abandoned baby. We came back, we checked back and rejected the bottom of the baby. That was my signal. 2 ATR stop above, 4 ATR profit target below, and I just set it and forget it. And then it rallied and went against me. I was like, oh, it might hit my profit target, but now it has come down. Still has not hit my profit target, but currently this short position on Alibaba is up right about 5.06%. And then last but not least on the dailies is IBB. In this particular example, you see that there is a red box. A lot of times you see the green boxes below, those are bullish order blocks. This is a bearish order block. What makes this a bearish order block? Well, over here on the 5th, we had a big bar up, followed by a big move down that changed market structure to the downside. So if you have you look for the highest close before market structure change, and now that area becomes the shortable area. And this is a market structure change because we took out this swing low. So now the way that I look at this turns this into a bearish order block. So if we come back and reject the order block, I am going to potentially take a look at a short. And that's exactly what I did here on the 21st of February. We came back in, we rejected the order block, meaning that we closed below it. I got short here at, what's that price? 138.90. I placed my emergency stop 2 ATRs above. I placed my end of bar stop a close below the high of the order block, 142.60. I place my 1.5 ATR trailing stop level below, and I take partial 0.45 profits if it starts going my way, in which case I'm short here. So the next day didn't do much. Next day it was down. I took partial profits. Next day it was down. I took partial profits. Next day it was down. I took again partial profits. Next day opened lower. Now I'm in trailing stop mode. And because I'm short, this means now if I have a close above a previous bar's high, I will get out of half. Next day looked like it was going to go up, collapsed to the downside, took more partial profits. Next day down again, more partial profits. And then here on the 5th was the first close above a previous bar's high after reaching trailing stop level. I exited half the short position for a gain of 2.32%. And then we rallied a couple more days, and then down more profit targets, down more profit targets, up and down on the days that it was down. I took partial profit targets. Then we had this 4-day stretch where we moved down, took more profit targets, move up. And then, of course, the last 4 days on this short were good for me in this trade, because here, big day down, took more profit targets. Next day, big day down, took more profit targets. Thursday, sideways, and then hit another profit target on Friday. So this trade doing very, very well. The remaining shares that I have on this particular short up 6.57%, but we are getting close to a 35 RSI to the downside. So if I get to a 35 RSI, now in the future, if I close above this 5 EMA, I am completely out of the trade. Just like if I get to a 65 RSI on a bullish trade and then it closes below the 5 EMA, I'm completely out of the trade. It's exactly reversed. And again, it may sound like I have a lot of rules here, and actually I do, but the rules are there for a reason. And I use these rules to trade for my living, and also this is exactly what I teach my students. And this is a deep dip buy rule. And again, if you'd like to learn deep dip buy and all the other strategies that I have, please contact me. Love to have you as a student. Best way to teach anything is one-on-one. And then also, by the way, if you like video courses, I talk a lot about the deep dip buy. I have a great video course just on how to trade the deep dip buy setups and all the rules. It's available at udemy.com. It's 9.5 hours of video. It's a great course, and it's very reasonably priced. And so if you're interested in watching that video course, the link is in the description of this YouTube video. So the remaining shares on IBB up 6.57%. Okay, so those are all the open and closed trades on the dailies. Let's quickly go to the weekly trades. Now, weekly trades happen on Friday because the bar closes on Friday, so you have to make your decisions. This is TLT. I've been in this trade for several months. Why? Well, again, weekly bars, I got long TLT about 117.25 at $87.50. Why? Well, look, we're in a bullish order block. And we also created a V1. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That is the confluence of signals, and technically also we had another confluence of signals, which is here's your negative third ATR channel. We closed below it, and now we closed above it. So we had a rejection of the order block, we had a V1, we had a rejection of the negative third ATR channel. I got long here, 87.20. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is just to close below the entry bar that I took. Why? Well, because of the V1. And if you have a V1, if you close below halfway of the V1 entry bar, that's a good tight stop. Really, it shouldn't close below there. And if it does, more than likely it's heading back down. So it was a very good tight stop. I placed my 1.5 ATR trailing stop level above. And this one, it's doing fine. And, nothing to write home about. But the next week it was up, no profit targets. Next week it was up, no profit targets. Next week it was up. I did hit a profit target. Next week, all over the place, but down, no profit targets. Next week up, but no profit targets. Here on the 28th, big week up. I did hit some profit targets. Now I'm also in trailing stop mode. And then for the next month, no profit targets at all, but it's kept me in the trade. And this kept me in the trade on Friday because it closed at 90.14. The low is 90.12. Look, the previous low was 90.12. This closed at 90.14. That is, it did close above, so that kept me in the trade. Otherwise, I would have had to have gotten out of half of the position. So this weekly trade, doing quite well, up 3.28% on the bond trade. DDM. Okay, DDM, you see the red box. What is that telling you? Well, that tells me that there is a bearish order block in a shortable area. Again, why? Here's your highest up bar close. Here we change market structure. This now makes this an order block. We rallied after change structure to the downside. We have this kind of reflexive up move, which happens very often. I took the short here, 103.70, because during the week it got into the order block and then closed below. So I got short 103.70, placed my 1.5 ATR trailing stop level below, my emergency stop 2 ATRs above, my end of bar stop, a close above the high of the order block at 103.57. And so now I know exactly what I'm going to do. If the next week it closed above the high of the order block, I'm out. If it zips up and gets to my emergency stop, I'm out. If it moves down, I take partial profits, and that's exactly what happened. Next week, what opened up down, I hit a profit target. Next week, nothing. Big down week, hit multiple profit targets. Next week, nothing. Next week, huge move down, took multiple profit targets. Now I'm also in trailing stop mode. Again, followed by another huge day where I hit multiple profit targets. Again, I'm in trailing stop mode. Next week up, this week was up above, but ended below. So it didn't close above a previous bar's high. I've been scaling out of this trade. And this particular trade doing really, really well, up 15.64%, all based upon the bearish order block. So up 15.64%. And then last but not least on the weekly is Tesla. I did take Tesla here on 314 at 249.99. Intra-week rejection of the 200-day moving average. Place my emergency stop 2 ATRs below. My end of bar stop is a close below the 200. The next week it was right on the bubble, but it closed just barely above the 200-day moving average. And then this week actually up on Tesla. It was much, much higher, but I did hit a profit target when it's near the top there. So it has not reached trailing stop level. It has not closed below the 200-week moving average. It did move up the value of 0.45 ATR from the previous bar's close, so I did hit a profit target, lock that in, and the current position that I have right now, it was up much higher, but currently still it is up 5.26%. So anyway, I hope that was helpful for you just to kind of get an idea of how I make these trades on the daily and the weeklies, how I enter, how I position size, where my end of bar stop is, how I take partial profits, how I exit the trades. And I know I have a lot of positions. I don't usually have this many positions, but there's just been a lot of signals. But I guess it's good, right? It's more real life examples for you to take a look at. So if you have any questions about any of these trades that I've had or why I did what I did, feel free to put them in the comment section. I'll do my best to get back to you and answer your questions. All right, so before we take a look at next week's potential trades, let's spend a few minutes on trader psychology, shall we? Okay, so this week's trader psychology comes from Larry Tantarelli at Blue Chip Daily. You can follow Larry over on X at LMT978. Larry's a very famous trader and author. And when Larry says something, I would probably tend to want to listen to it because he would give good advice. So the best time to manage risk is every day, based on how much cash we hold, stop placement, position, sizing, and not over trading. Book some gains on the way up, move up stops, spread the positions, don't overtrade, basics that need to be done every day. not just when the markets pull back. And this is important because when the markets are going up, people really don't follow their rules because they think everything is going well. When we start getting in these big pullbacks, then yes, people get a little bit more detailed to their rules. But the reason I picked this is a good example in reinforcement of everything that I teach and everything that I just showed you in the trades that I have. Everything that he's talking about here, I incorporate into my trading, and this is what I teach my students. So let's go back through it a little bit more carefully. The best time to manage risk is every day. Well, based upon what I just showed you, I have rules for every day, right? Based on how much cash we hold, well, that is when you position size. Remember, it's based upon 1% of the value of your account, at least the way that I do it. So the count moves up, I trade more. The count moves down, I trade less, right? So based upon how much cash we hold. Stop placements, I told you about emergency stop, end of our stop, position sizing, and not over trading. Okay, well, position sizing is using the 2 ATR and not over trading. When we take a look at the potential trades for next week, if you listen to this channel, you know I always talk about I only take one trade per day, the best trade out of a whole group. And that is right here. So I do not overtrade. Book some gains on the way up. Well, of course, I take partial profits at 0.45 from the previous bar's close. Move up stops. Okay, move up stops. That's what your trailing stop level does. Spread the positions. I try to buy as many different type of companies. I don't just look at tech. I look at all sorts of companies, industries. I look outside, commodities, oil, gold, so forth and so on. Don't overtrade. Basics that need to be done every day, not just when the markets pull back. So, the approach that I use, the process that I use, I look at it every day. I just don't look at it in big picture. I look at it every day. So just another example of everybody of why you need to get yourself a trading process that incorporates everything that I just mentioned. How much cash we hold, position size, not over trading, booking gains, moving up stocks, spreading the positions. So thank you, Larry. I hope this was helpful for you, but keep in mind, get yourself a process that you know exactly what you're going to do regardless of the market does, and whether it's going your way or against. It's really the only way, in my opinion, everybody. So, okay, let us now take a look at the potential trades for next week. And again, like I just mentioned, here I have 12 symbol potentials on the daily. Now, they're not to where they need to be yet, but if theoretically all 12 of these could trigger on Monday. Does that mean I would take all 12? No. I would take the best one of the group. And how do I determine that? I give each potential setup a quality score. If it has 2 signals, I give it 2 points. If it has 1 signal, I give it 1 point. Right? I look at the higher time frames to make sure that maybe there's some support or a signal on the higher time frame as well as the time frame that I'm trading. So I look at the relative strength of that market compared to the other potential candidates that I have. If the market's down, but this particular stock is up on the day, then it has a higher relative strength. That gets it extra point. So at the end of the day, if all 12 of these signals, I'll be able to pick the best one because it will have a higher score. Again, I look at risk to reward ratio, what the multiple signals, the more signals, the higher the score. I look at the higher time frame, I look at the relative strength. And so it's important. And this is another way to not overtrade and just take and pick the best stock of the day going forward. And again, this is how I do it. This is what I teach in my one-on-one courses. So, if you would like to learn this, just contact me. I'll teach you exactly how to do it, in addition to teaching you all the trading approaches that I use and all the rules. You'll be glad you took the class. I promise you, you're going to be a much better trader. And my email is in the link of the description. if you'd like to contact me. So, okay, here we go. Let's start off with ARKK. These are the dailies, then we'll go to the weeklies. So ARKK, what's going on down here? Well, you see the green box here. This is a bullish order block. This is a buyable area. But on Friday, had this rejected the top of the order block, or in other words, had it come down in the order block but closed back above, I would have potentially gotten in the trade, but it did not do that. So now I look at two other levels. You see this green line inside this order block. What is that? Well, here we have a V2 kind of situation where you have the biggest down bar. Halfway at that big down bar, you should find some support. Look, you found it right here too. See how we got to halfway of this and then bounce? So I'm looking at this 48.10 level inside the bullish order block. Monday, for example, if we open below it and then close back above it, that's a rejection of the halfway of this big down bar. That would be a potential trade for me. And if I entered that, then I could have to choose two stops. If Monday it went below or just bounce it halfway and then close back above, I may use that as my end of day stop. It's a lot closer, better risk to reward ratio. Or conversely, I could just simply use a wider stop at the close of the order block. Now, if we don't get there on Monday, but maybe we close back above the high of the order block, okay, then I could potentially get in there as well. So I'm looking for a rejection of either the bottom of the order block or rejection of halfway of this down bar here on the 13th, which is at 48.10. So we are in this bullish area here. I know it doesn't look very bullish here, but this is where it came last time. And the way I like to explain order blocks is, you see an order block, a valid order block, after it's moved up. So order blocks to me, a good way to explain this, order blocks to me is where the smart money came in to buy and the weak money got out. Because obviously, if we look here, was that the smart money? Well, it was, because we moved up. And was this the weak money that got out? Yes, it was. So now that we're getting back into the same place that the smart money came in, that's probably the time to buy it again, because it has shown its hand. This was the area. Doesn't mean it has to go up. Things change. This could go down and lose the order block. Things change. But as of right now, if you talked to me 5 days ago, you certainly would go, well, yeah, that is where the smart money bought last time. So now we're coming into that same area again. So rejection of the top of the order block potentially. Close back above the 300-day moving average potentially. If we go lower, rejection of that 48.10 level, or rejection of the bottom of the order block. So that's what I'm looking for on ARK. CCJ, okay, a lot of these are going to look the same. Here's your bullish order block. Why? Lowest bar close before we change market structure. Now we're coming back down to it. So potential rejection of the high of the order block at about 41.48 might be a level. I have halfway of the V2 bar here. From the V1 back over here. See the big up bar? Halfway down should have some type of support, and that support at 48.89 resides within the bullish order block. So rejection of the high of the order block, or rejection of the 48.49 level, which is halfway of this big V1 bar, or a rejection of this bottom. So I can't tell you exactly. I don't know how it's going to play out. I'm just telling you the potentials. Rejection of the high of the order block, rejection of 48.49, rejection of the low of the order block. That's what I'd be looking for on CCJ. Carnival, CCL. Okay, very similar. Look, here's your order block, somewhere between about 1924 and 1814. Here's a V1 bar, up bar halfway, 1860. So CCL, there's a lot of potentials here. If we bounce off the top of the order block, would make sense. There's also a 300-day moving average. You can see it right here, the orange, that resides right at the top of the order block. That would also make sense. So essentially, if we reject the high of the order block, we've rejected the 300-day moving average as well. That would be an interesting entry, really. If we come lower, get halfway to the big up bar here on 311, which is 1860. That would also be a potential entry or a rejection of the low of the order block at about 1810. What is that exactly? 1816. So somewhere in this area. So again, rejection of the high of the order block would be good because it would also reject the 300. Then you could use the 300 as the stop. Halfway of the up bar inside the order block 1860, or rejection of the low of the order block at 1816. Salesforce CRM. Don't talk about this much. But this is very interesting. And this is, we haven't talked about this because we haven't had them, but now we are starting to get these on a lot of the charts, which to me, these are bullish, but we haven't talked about it lately. Look, we are in a significant double bottom bullish divergence. What does that mean? Well, look at the lows over here. Look how deep the red MACD bars are. MACD are momentum indicators. It's showing you that the selling momentum was very strong. Then the bottom was put in, we rallied, had some green MACD, but now look, we are back now at the current lows. However, even though we're just as low or lower now than we were over here, do you see how we don't have any red bars? This is called the double bottom bullish divergence, and this one's even stronger with a missing right shoulder. So even though we're lower here than we are here from a MACD perspective, it's not showing any red MACD bars. So really all that means is that even though it looks like it's down significantly, which it is, from a MACD perspective, the momentum is slowing. And what does that mean? If the momentum's slowing, it means you're running out of sellers. And if you run out of sellers, the implication is that you will go up. Now, just because we're at a double bottom bullish divergence doesn't necessarily mean anything right now. I mean, big picture, it's great, but you still need an entry signal. And the entry signal that I see right here, right now, is a deep dip buy under 30 over 30. Right now, we're at 33.97. I would need an intraday rejection of the 30 RSI or a close under, close back over the 30 RSI. But big picture, the lay of the land on this from a MACD perspective looks really good. But I still need the entry signal. And again, the entry signal, about the only entry signal I can see right now would be an intraday rejection of the 30 RSI or a close under, close over the 30 RSI. But so I'll be watching that one carefully. Goldman Sachs. Okay, this actually was a legitimate entry signal on Friday. I did not take it because I really have so many other positions going on and I wanted to not get too many positions. But look, here's our order block. Lowest bar close before market structure change. Here's the 200-day moving average. On Friday, it rejected both of them. It rejected the 200. It rejected the top of the order block. I didn't take the trade. And really one of the reasons I didn't take the trade is that I'm more hesitant to take a trade if my signals get signaled, trigger, when it comes on a huge, huge down day. That's really it. But letter of the law, yes, I absolutely could have taken this on Friday, but I just chose not to. But going forward, I'm going to watch it very carefully because it's exactly where it needs to be. Maybe a close under the 200 and then a close back over the 200, which would also be a close in the order block and then back over the order block. So again, this is a legitimate signal. I just decided to see if it might test it one more time, a couple more times before getting in. But I am going to be watching Goldman Sachs. Another retest of the 200 would make me feel a lot better. If it goes lower than a rejection of halfway of the washout bar on the V2 here at 528, or a rejection of the bottom of the order block about 519.88. So if we reject the 200 again, meaning we go below it, close back above, it would also reject the high of the order block, so I would look at that carefully. That's one potential rejection of the high of the order block or the 200 again, rejection of about halfway in the order block at 528 or rejection of the bottom. And if we go lower, of course, we have the 250, we have the 300 there as well. Let's go to Meta. Meta also was legitimate. on Friday. I didn't buy it. Here we have the green order block. Here we have the 200-day moving average. It did reject the 200, but again, I didn't take it because the bar was so massive to the downside. That concerned me. Letter of the law, yes, it's legit, but it did not reject the top of the order block. So I'm just going to give it another day. I think we're getting close to some very, very important levels here. Look, we have the 250-day moving average in the bullish order block. If it gets there next week and rejects, man, I'm taking it. And on top of it, we have a double bottom bullish divergence. Look at the lows. Look at the deep red MACD. We rally. Now we're just as low here as we are here. No red MACD. So it's a double bottom bullish divergence. And that is bullish. And we are in bullish areas. So we'll see what happens next week, but we are getting into some pretty strong levels of support. But again, the reason I didn't take Meta was because it was such a big down bar that got us to the 200. I really would like to see it reject the top of the order block and then go back above the 200, show some stability. Microsoft. This is an order block from a million years ago. If you go all the way back, my gosh, look, all the way back here in 2024, here was an order block. Go out into the future, put that out in space. We are getting very close to that order block. So this one's pretty simple. Just a rejection of the high of the order block, I would potentially get long. And we are working on a double bottom bullish MACD divergence as well. Palantir. Palantir has held up much stronger than the rest of the market. I mean, look, we're above the 100-day moving average. The rest of the market's down here in the 200, 250, 300 range or lower. So what I'm looking for on Palantir, here's an order block. Here is your lowest bar close before you market structure change. You put the order block into space or out into the future, and these are the levels. So the high of the order block is 82.69. The low of the order block is 74.57. So next week, if we reject the high of the order block, I may get long there. If we reject the low of the order block, I may get long there. If we reject the 100-day moving average inside the order block, I might get long there as well. QQQ. Okay, so big picture, we have a beautiful double bottom bullish divergence happening right here. We are in the first order block, lost the 300-day moving average. Next week going forward, if we reject the low of the order block, that would be a legitimate entry. The low of the order block is 466.43. If we continue down, there is a lower order block that you can see that I drew below that. And this goes all the way back to the order block here on this September 6th, 2024. I can't believe we're all the way back down there, but we are. So two levels that I'm looking for on Qs, again, is a rejection of this higher order block low of 466, or if we go lower, a rejection of the high of the order block at 460.81. Another way to look at this, I could look for a deep dip buy. It's right now, it's 36.79. A rejection of the 30 RSI would be a legitimate deep dip buy area, and that would come in this order block. And again, on top of it, beautiful double bottom bullish divergence is forming. RSI divergence, ATR divergence. You know, in my experience, I think we're getting close to a low. I could be wrong, but that's what all the technicals, the MACD, the ATR, the RSI, the order blocks, the low RSI readings, they're all telling me we are getting, well, not getting, we are in those levels right now. But whether it holds is anyone's guess. S&P 500, this one's pretty simple. Here's our order block. Here's the 300-day moving average. Last time, the S&P literally, I mean, it was 5, 10, 15 cents to the 300-day moving average. I mean, it tagged it to the penny, actually, and then closed a little bit above. Will it hold this time? I don't know. But whenever I have a 300-day moving average or a 250-day moving average or a 200-day moving average coinciding in an order block, I'm going to pay attention. So Monday, if we come down, reject that 300-day moving average that's also in the order block, I, you know, very possible I would take that trade because that's a strong signal. You haven't had this signal in 2 years. So, and on top of that, I can see the double bottom bullish MACD divergence beginning to form. So I would be watching this 300-day moving average inside the bullish order block very closely. United Airlines, UAL. Oh, good. Okay. This is a very clear, simple entry. Here's your order block in the green. We change market structure to the upside. Look at the 250-day moving average that resides in the order block. We're at a 33 RSI. Essentially, if we come down more, reject the bottom of the order block, or we reject the 250-day moving average, very likely we will have also rejected the 30 RSI. That would be a major confluence of signals right there. So hope that makes sense. Looking for a rejection of the 250 next week or a rejection of the bottom of the order block to finalize the double bottom bullish divergence. Also test the 30 RSI. So a lot of signals there. Major moving averages, order blocks, low RSI readings, double bottoms, bullish divergences. So I haven't seen this quality of setup for years, honestly, on a lot of these stocks. And then Walmart. Okay, this one's pretty good too. Order block from 82.57 to about, let's see, 80.85 to 82.37, coinciding with the 200-day moving average. I could look at this two ways. I could take a rejection of the 200-day moving average. That would be valid. I could also take a rejection of the high of the order block or a low of the order block. And again, we have a double bottom bullish divergence forming here. So those are the dailies, everyone. I hope that was helpful. Let's take a quick look at the weeklies, and then we will get out of here. And if you've made it this far, congratulations. Okay, here's Budweiser. Straight down, straight up. Why? It's a safety play. You see the order block, the bearish order block above, 66.40 to 65.18. This is a bearish shortable area, but we need to reject the bottom of the order block or reject the top of the order block. If you see this happen, if you see Budweiser start to come down, very likely the rest of the market will be going up because money will be flowing out of the safety trades back into the growth stocks. So that's what I'm looking for. Not only just for a short on Budweiser, also kind of a bit of an indicator for the markets as well. Home Depot. Really nice signal on the weekly. Beautiful. Green order block, 200 week moving average inside the order block. The 200 right now is at 321.24. We're at 358.15. Don't know if it's going to get there. It may get there. And if it rejects the 200, yeah, I would be buying because it would give me a very good risk to reward ratio. But the three options I should say are rejection of the 200 next week, rejection of the high of the order block at 333.98, or rejection of the low or the order block at 316.86. I mean, this one is unlikely to get there, but if it does get there, look back in time. That order block, was that the smart money? It sure, clearly it was. So when it gets back down to the order block, you're buying where the smart money bought last time. That's why the order blocks tend to work. But then again, things can change. So maybe the smart money doesn't buy here this time. But that's what I really like in these order blocks. They show you where the smart money was by the fact that, I mean, up here and you look back, was it smart to buy there? Yeah, of course. So it may be smart again to buy here. Microsoft on the weekly. Okay, we have an order block on the weekly, goes all the way back to here. Here's your lowest bar close before market structure change. Was it smart money to buy here? Yeah, it was, clearly. Now we're getting back to the area that smart money was buying. so maybe we'll bounce again. Maybe, but that's the way we have rules. So I'm looking for a rejection of the high of the order block here at 372.24. Looking for a low of the a low of the order block at 362.67. And then last but not least, everyone, NVIDIA on the weekly. Remember when everyone loved NVIDIA? Lowest bar close before market structure change. We have been kind of flirting around with the high of the order block. A few weeks ago, we did get into the bullish order block on the weekly, closed above, and now we're coming back down. So a rejection of the high of this order block at 108.77. I really like this $99 level inside because this is halfway of this up bar here, back here on the 9th of August, or a rejection of the low of the order block. So a couple different options. Rejection of the high of the order block at 108.66, a rejection of that halfway of that washout bar at 99.10, or a rejection at about 90.34. So all in all, everyone, we are getting into some very important levels, a lot of confluence of signals. I understand it is hard to buy at these levels when the news has been so bad, the sentiment has been so bad. But if you never take the trade, you're never going to experience the upside. So for me, even though things look bad, there are so many good signals that I'll take them. If they're legitimate, I'll take them. But I have very strict rules. If I'm out, okay, I'm out for a little loss. Hopefully a little loss. My worst case scenario is a 2 ATR loss, right? But if you look back through history, these deep dip buys and these order block areas, you look back at them and go, why didn't I buy those? Well, the reason you didn't buy them because you were scared at the moment. Well, that's exactly where we are here, but we're in really strong levels. So listen, if I can help you with trading, I'd love to have you as my one-on-one student. Send me an email. If you'd like to learn more about the deep dip buy, just in a video format setting, I have the deep dip buy course available at udemy.com. The link's in the description. If you have any questions about anything I mentioned today, I'm happy to answer. I always leave off with, please try to go out and do something nice for someone today. It really would make the world a better place if we could all do one nice thing for another human being. If you could also try to do one nice thing for an animal, that would also make them feel good, make you feel good, just make the world a better place. But I appreciate you being here. Be careful next week. Follow your process if you have one. If you don't, get one, right? And God willing, I'll see you next week. So thanks, everybody. And on the way out here, I have to run the U.S. Legal Disclaimer. But thanks for coming. Thanks for your time. Have a good rest of your weekend. Bye-bye.
Required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit, No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.